All right, a continuation of Chapter 15 here. Investments in international operations. This is a major accounting challenge because of foreign currency translations. You got to account for sales or purchases listed in a foreign currency, and there's an exchange rate. There can be profits or losses associated with this. And then preparing consolidated financial statements with international, because that international component is in another currency. So currencies is a huge factor. Let me give you an example here. We'll just look at the currency market, and here's some real quick. You see there's about half a dozen or a dozen securities, international currencies listed. Actually, big major trading banks will have a desk that trades in these currencies for almost all countries, whether it be Russia or China or South Korea, North Korea on there. And it's a big profit desk for a large bank, such as like Bank of America or Citibank and so forth. And on estimate, it's estimated that about over $3 trillion is exchanged in the currency markets per day. Per day. This is a huge market. I'll just give you an example of the US dollar. And we'll just go to, and again, they'll separate it out. Cash is what's also known as the spot market. This isn't going to be tested, so don't panic here, but I just want to introduce it here. And then there's purchases for future deliveries. This is how companies hedge themselves in the currency markets. You will get introduced to this in more detail in your finance class, but I'm not going to do so here. Let me just give you an example of the cat. This is a picture of the US dollar against a basket of foreign currencies. Not once, it's not against the ruble, i.e. Russia or the Mexican peso, but as a group of them. And let me just give you a 25-year picture of the fluctuations of these currency markets. And these currency markets will fluctuate literally by the second, and sometimes significantly. So it's a very, very active market, and the accounting profession has had trouble keeping up with this. And one of the areas, for an example, that can create problems is sometimes some countries go into hyperinflation, where the currency values are not stable, and so forth. I'll give you an example: Zimbabwe in Africa. In the late 1980s, early 1990s, Mugabe got in power and started inflating that currency. And when he got in power, a loaf of bread was $1.25. And 10, 12, 14 years later, toward the end of his reign, a loaf of bread was $12.5 million. The accounting profession has trouble dealing with that one. So, and this isn't going to go away. I think worldwide, we have a global currency issue. I'm not going to, again, make you expert on it, but this is going to be a growing challenge for the accounting industry here. Anyway, let's get back to basic accounting. You just want to get through this chapter in this class. So, exchange rates between currency. Each country uses its own currencies for international economic transactions. Not completely true. For instance, the countries in Europe have banded together, and they now use a common currency called the euro. Other than that, Brazil will have its own currency. China, again, a variety of other countries have not banded together, so they do operate their own currency. And to buy and sell on that, there's a cost to do this, and it's called an exchange rate. And there will be a bid and ask of these prices, and there could be, again, a lot of profits or losses associated with this. Here they're recording, like for instance, and again, I'll give you an example. We're not going to go very far. Go to your liquor store here in any community, and you'll see foreign wines or foreign whiskeys or so forth. Chances are they're dealing in foreign currencies if they're buying from an international based exporter, as an example. So you don't have to go very far to see this. And you see a recording as an exchange rate, you might have to convert it to dollars. In that conversion process, someone will have market risk based on that currency position, whether you're holding it in the euro or holding your always an exchange risk here. And there might be a gain. And again, you're going to label it as foreign exchange gain, foreign exchange loss, and so forth. And here they're showing a loss, maybe. So, and that loss is just based on the exchange rate changing, is what's happening here, or as well as your gains. And here's an example of the euro being converted to dollars. I'm not going to make you an expert at this point, but I do want you to at least be aware that this is a very big challenge for the accounting profession. Let me get into a comprehensive balance sheet. This is at the end of this chapter. So what does a comprehensive balance sheet look like after this chapter? Again, you're going to record certain things like short-term investments. What is short-term? Those investments held for less than a year. And they're just simply held at fair value. You don't really adjust for market price changes because it's so short-term. And usually these short-term investments are almost always debt securities. So investments in stock, they're separating out the 20% and the 50%, and they're reporting them separately. And their own separate line items here. You're going to have unrealized gain on securities here under the stockholders' equity in the equity section of the balance sheet. So this is starting to get more expanded, this balance sheet and so forth. And then you got to consolidate with international subsidiaries. A subsidiary is a word used to reflect that another company owns that company. And so you have to merge those two together. That's for later in your international or advanced accounting. That's the end of this chapter. Call me if you have any questions.